Hi, this is Marzban Irani from LIC Mutual Fund. I'm heading the fixed income here. I joined LIC Mutual Fund in 2016. My role basically is to monitor the research side and the traders in the dealing room and the fund management side. Myself, I manage some of the duration funds. I joined in the year 2000, and since then I worked in the mutual fund industry and the insurance sector also. It's been more than 2 decades that I've been here. Coming to the processes, that is the first thing that we focus on the research side. We have all our decisions that we take, whether on the investment side, which new papers to buy, where the limits are to be increased or decreased. Everything is taken through the credit committee. We have a team of 3 credit analysts who do the necessary work and present in the committee. We also have a risk manager, head of risk, who is having an investment background, who was a fund manager earlier. So that complements our role. Coming to the trading side or the fund management side, we follow the SLR process, the safety, liquidity, and then returns. Safety is of paramount importance to us because we believe that debt is for stability and equity is for growth. So when you talk about stability, we are very conscious when we are buying any papers. Secondly, we focus on the liquidity because we have seen 2008 financial crisis, we have seen the COVID period, and the central banks all over the world had to actually intervene to provide liquidity into the system. So that's why our focus is on liquidity also. Whenever we are buying any paper, we try to put one foot in the water and see how deep it is. That gives us some indication where the market is heading. We are more into the duration calls. We take more of duration risk compared to the credit risk, because credit risk is permanent in nature. If a paper goes bad, then it becomes very difficult to recover that money. But whereas in case of duration risk, even if your call goes wrong, at some point in time, the market turns and then things improve. So safety, liquidity, and obviously once you follow these two, your risk adjusted returns follows. Next, we go into the product. I'm going to talk about banking and PSU debt fund. So as the name suggests, we invest in banking and PSU papers in this product. We have done a laddering as a strategy, 1 year, 3 year, 5 year, 7 year, 10 year kind of thing, so that we are able to capture the whole yield curve. SEBI has defined the durations across the categories, but in case of dynamic bond fund, as the name suggests, and in case of banking and PSU, these 2 categories, SEBI has not defined anything. But at the moment, we are running it around 3 to 5 years kind of maturity, because we have products in 3 years, we have product in 10 years, 7 years, but we didn't have a product in this 5-year category. So we are running it over there at the moment. So basically, when we are in a falling interest rate scenario, we are at 5 years. And when we are in a rising interest rate scenario, we'll be more towards 1 year in these type of products. Just one small advice to the retail investors. Nowadays, a lot of apps are coming in the market, and people are tempted to, trade, through that in the GSEC market also. Unlike equity, I just want to caution that in case of fixed income, the two-way prices are a challenge sometimes. So it's better to go to your advisor, take the right advice, and then go through the necessary channels and invest your money on the fixed income side. Thank you.
Investments in the securities market are subject to market risk. Read all the related documents carefully before investing.